So the markets are not looking so healthy worldwide due to this ongoing pandemic. And you have some spare money lying around, which in your assessment needs to be quickly invested in the equity markets. Because, hey, we're at the bottom, aren't we? I have some questions for you before you decide to click that Invest Now button. Keep watching. Welcome to the State of Finance. My name's Abhishek. If you're considering investing a lump sum in the equity market through stocks or mutual funds, ask yourself the following questions first. These questions are very much relevant during normal circumstances as well, and even carry more weightage during times like these. We are talking about long term here. Be absolutely sure about not seeing this money for long term, which is in the next 7 to 10 years. Ask yourself whether you will be fine to lock it in, because if you overestimate your financial situation now and then resort to pulling this money out before the expiry of at least 7 years, you'll probably be fetching some suboptimal or even negative returns. It is true that markets have seen ups and downs a lot of times in the past and have come out strong. And from history, we can learn that this pattern should repeat itself, but the recovery could be slower this time. So assuming long-term period to be at least of 7 to 10 years would be prudent. The second point is basically an extension of the previous point. Do you have any project or plan that might require some or all of this money in the coming years? When people invest in real estate, they usually hold on to it for as long as they can. Real estate is their last thing on their mind to sell, even in time of emergencies. The first victim of any type of emergency is your bank money, and then the equity. So the money is taken out before the actual planned time, which often leads to some kind of loss, and then people have lots of negative things to say about the equity markets. Think about some major financial events like your children's marriage, your children's education, some business project, or any other goal which falls before the 7 to 10 year time limit, and maybe you haven't fully planned for it. So take that into consideration as well. How good does your emergency fund look? Setting up and maintaining an emergency fund is the first step in financial planning. There's no magical number. It's whatever that makes you sleep well at night. Maintaining at least 6 months worth of expenses as emergency fund is a good idea generally. You can even go higher. I had talked about it in my earlier videos last year. I will provide a link to it in the description box below. You must have noticed the sad situation these days, where so quickly so many people lost their jobs or suffered losses in businesses, and they needed some support package from the government in different countries. Emergency fund provides a cushion during such hard times, and yes, if you already have one, review it. Just check if that number needs some increment. How well are you insured? Now that you have witnessed the pandemic and you are still going through it, maybe you have realized that taking medical and life insurance way more seriously is the way to go. Your life insurance depends upon your age, income, debt, health status, number of dependents on you, etc. Every earning person should have a life insurance cover. If you ask me about a general life insurance formula, it would simply be your annual income times 10, and then adding the outstanding debt amount to it. For instance, if your gross income is about $50,000 a year and you have a personal loan balance outstanding for about, say, $20,000 today, the cover required would be $50,000 times 10 and adding $20,000 to it, which comes to $520,000. Similarly, health insurance is also vital for all the members in the family and not only the earning members. How experienced are you, and have you ever tested your risk-taking capabilities? When everything is fine, the markets are high and melodiously singing, any new investor will be full of confidence. Based on the recent returns, investors get over-optimistic about being able to tackle all the ups and downs in the market, and they expect to earn the same kind of historical return figure. Tell them about the potential short-term volatility in the market in the future, and they'll be like, yeah, I'll be fine. And when after a few months of investing, they feel the market starting to shake a little, They are the first ones to doubt the safety of their investments in the long run. This clearly proves that the assessment that you did of your own self was, well, not so accurate. And perhaps you were too brave and optimistic in your own eyes. It's true that in the long run, point-to-point returns are positive and amazing, but it's that time between today and the future date which will have a lot of disturbances in the short and medium term, which you, as an investor, will have to learn to absorb. Since the share prices or mutual fund unit prices are so transparent, investors tend to check them more often. It's just human nature. Having too much transparency in valuation is not always a positive thing, I think you might agree. Are you still sure that the markets are at the bottom? Sure, the markets globally are not looking in a healthy shape. But one thing to note is that the final impact of this emergency on the earning capacity of even the large companies and the economies as a whole is still vastly unknown. Base your analysis on the price to earnings ratio of the companies you're planning to invest in. Be careful, some company stocks can still be overvalued. After all that brain-bending exercise and self-analysis, if you still feel okay, you still can spare some money to invest as lump sum in the market, go ahead, but use the STP route, which stands for Systematic Transfer Planning. It is a shorter version of SIP, which I will explain in a separate video. Maybe today is the lowest the markets ever get, or maybe it's gonna be after a month. No one really knows. And as I always say, it's not about timing the market, it's about time in the market in the long run that matters. So to sum it up, I'd say just stick to your monthly investments, revisit all the questions that I outlined in this video, and if you still are convinced that you'll be fine investing some extra chunk of lump sum money, then take the STP route. I hope this video was of some value to you. If you like the video, you can support us by sharing the content and subscribing to the channel. I will see you in the next video. Till then, work smart and invest even smarter. Peace.